Every monetary system collapse begins the same way, not with hyperinflation, not with bank runs, not with dramatic market crashes that make headlines across financial media. It begins with coordination breaking down between the institutions that created the system in the first place. And when central banks, the architects of modern monetary policy, start moving independently, when the carefully orchestrated dance that has held global finance together for 50 years begins to fracture, history tells us exactly what comes next. On January 17, 2026, something happened that most people missed entirely. The Federal Reserve announced a 0.25% interest rate cut, standard monetary policy adjustment. Nothing unusual about the decision itself. Economic data clearly supported the move. Inflation had dropped to 2.1%. Unemployment had ticked up to 4.4%. Consumer spending showed signs of deceleration. Manufacturing activity contracted for 2 consecutive months. Classic conditions for monetary easing. Except for one critical detail that should have sent shockwaves through every financial market on Earth. The European Central Bank had raised rates by 0.50% just 72 hours earlier. And the Bank of Japan maintained their negative rate policy, while the People's Bank of China tightened liquidity significantly through reserve requirement, increases, and open market operations. The Reserve Bank of Australia held rates steady, while the Bank of Canada cut by 0.25% on the same day as the Federal Reserve. 6 major central banks. 6 completely different directions in the same week, during what should have been a coordinated response to global economic conditions that affect all developed economies simultaneously. This doesn't happen when systems are stable. This doesn't happen when coordination mechanisms function effectively. This doesn't happen when the invisible architecture of global monetary policy operates as designed by the architects of post-Bretton Woods international finance. This only happens when the underlying framework, the structure that has governed international monetary relations since the collapse of the gold standard in 1971, starts coming apart at the foundational level. We've seen this exact pattern before. August 15, 1971, President Nixon announced the temporary suspension of dollar convertibility to gold during a Sunday evening television address that shocked global markets. The Bretton Woods system, which had coordinated global monetary policy for nearly 3 decades through fixed exchange rates and coordinated central bank intervention in currency markets, collapsed within 18 months. Not because of a single catastrophic crisis, not because of irrational policy decisions by incompetent officials, because coordination became mathematically impossible when underlying economic realities diverged from monetary arrangements that required unified action across all major economies. The pattern repeats consistently throughout monetary history. Always the same sequence. First, coordination works effectively because economic interests align across major economies. Growth rates converge. Inflation patterns stabilize. Trade imbalances remain manageable. Central banks can move together because the same monetary medicine works for everyone. Then economic pressures build differently in different regions as structural imbalances accumulate over years or decades. Demographics diverge along different trajectories. Energy dependencies create different vulnerabilities. Debt levels reach different critical thresholds. Industrial structures develop different competitive advantages and weaknesses. Growth patterns become fundamentally incompatible. Then central banks start prioritizing domestic mandates over global stability because domestic economic conditions force their hand. Constitutional obligations to domestic price stability and employment cannot be ignored for international coordination. Then coordination breaks down systematically as each central bank responds to different economic realities. Then the entire system fractures into regional monetary blocks operating under different rules. What we witnessed on January 17th was not 6 independent policy decisions made in isolation by central bankers operating without communication or consultation. It was concrete evidence that global monetary coordination, the invisible architecture that has prevented major financial system breakdown since the collapse of fixed exchange rates in the mid-1970s, no longer functions effectively under current economic conditions that have diverged beyond the capacity of coordinated policy to address simultaneously. The Federal Reserve cut rates because United States economic data clearly indicated softening conditions, requiring monetary stimulus to prevent recession. Consumer spending had decelerated for 3 consecutive months, falling from 3.1% year-over-year growth to 1.8%. Manufacturing activity contracted sharply as the Institute for Supply Management's manufacturing index dropped to 47.2, indicating significant industrial weakness. Regional Federal Reserve, surveys from Philadelphia, Richmond, and Kansas City all showed declining business confidence and reduced capital investment plans. Corporate earnings guidance for Q1 2026 indicated widespread expectation of reduced profitability. Inflation had fallen from 3.2% to 2.1% in 6 months, well within the Federal Reserve's 2% target range and showing continued disinflationary momentum. Unemployment rose from 3.9% to 4.4%. suggesting labor market loosening that could accelerate if economic conditions continued deteriorating. Standard economic indicators all pointed unambiguously toward the need for monetary accommodation. The 0.25% rate cut was textbook central banking, operating exactly as prescribed by decades of monetary policy research and practical experience. But the European Central Bank raised rates by 0.50% because Eurozone economic conditions demanded immediate monetary tightening to prevent runaway inflation. Consumer prices had accelerated to 4.8% year over year, well above the ECB's 2% target, and showing continued upward momentum. Core inflation, excluding volatile food and energy prices, reached 4.2%, indicating broad-based price pressures across the economy. Wage growth in Germany reached 5.3% annually, the highest level since the reunification boom of the early 1990s. French consumer spending surged 4.7% year over year, well beyond sustainable levels given productivity growth. Italian government bond yields spiked to 4.1%, indicating market concerns about fiscal discipline and debt sustainability. Spanish unemployment fell to 11.2%, the lowest level in 15 years, suggesting tight labor market conditions requiring a policy restraint. The ECB faced classic economic overheating conditions, requiring immediate monetary restraint to prevent inflation expectations from becoming unanchored. The 0.50% rate increase was textbook central banking. The Bank of Japan maintained negative rates at 0.10% because Japanese economic conditions remained stubbornly deflationary despite decades of extraordinary monetary stimulus, including quantitative easing, yield curve control, and forward guidance. Core inflation registered just 0.8% year over year, well below the Bank of Japan's 2% target that has proven unreachable for over 20 years. Wage growth remained anemic at 1.2% annually despite chronic labor shortages in key sectors. Consumer spending declined for the fourth consecutive quarter as an aging population reduced aggregate demand structurally. Business investment contracted 2.3% year over year as companies preferred overseas expansion to domestic capacity increases. The yen's relative weakness provided the only source of export competitiveness for Japanese manufacturers competing against Chinese and South Korean rivals. Any monetary tightening would trigger immediate economic contraction and accelerate deflationary forces that have plagued Japan since the asset bubble collapse of the early 1990s. Continued monetary accommodation was the only viable policy option. The People's Bank of China tightened liquidity through targeted measures because Chinese financial conditions indicated dangerous credit expansion, requiring immediate preemptive action to prevent systemic banking crisis. Total social financing grew 12.8% year over year, well above the PBOC's target range and indicating excessive credit creation across multiple sectors. Property sector debt reached 28% of GDP, approaching the crisis thresholds observed in previous real estate bubbles that triggered major banking system stress. Shadow banking activity increased 15.2% year over year as formal lending standards tightened, indicating regulatory arbitrage and potential systemic risk accumulation. Regional bank stress tests indicated capital adequacy concerns in second and third tier institutions heavily exposed to property development and local government financing vehicles. Corporate debt-to-equity ratios reached historic highs across multiple industries, suggesting overleveraging that could amplify economic downturns. The PBOC faced classic credit bubble dynamics requiring preemptive action before systemic risk became unmanageable. Liquidity tightening through reserve requirement increases was the appropriate policy response. The Reserve Bank of Australia held rates steady at 4.25% because Australian economic conditions indicated a careful balance between growth support and inflation control. Mining sector revenues remained strong due to Chinese commodity demand, supporting government revenues and regional employment. Housing prices showed signs of stabilization after 2 years of decline, indicating market equilibrium. Consumer spending remained resilient despite higher borrowing costs. Inflation tracked toward the RBA's target range without immediate pressure requiring policy adjustment. Currency stability remained critical given Australia's position as a commodity exporter, dependent on Asian trade relationships. The Bank of Canada cut rates by 0.25% to 3.75% because Canadian economic conditions mirrored those in the United States, with additional complications from trade relationship uncertainty. Manufacturing activity declined sharply as uncertainty about USMCA renegotiation affected business investment decisions. Consumer confidence fell to 5-year lows amid concerns about housing affordability and employment prospects. Inflation remained well controlled at 2.3%. Providing room for monetary accommodation. The Canadian economy's close integration with the United States suggested following Federal Reserve policy to maintain exchange rate stability and trade competitiveness. 6 different economic situations, requiring 6 different monetary policy approaches. No coordinated solution existed that could address all conditions simultaneously without creating severe problems in multiple economies. This divergence reflects fundamental structural differences that have accumulated over decades of seemingly coordinated policy that masked growing imbalances. Energy dependence varies dramatically between major economies, creating different inflation vulnerabilities when global energy markets fluctuate. Europe imports 60% of total energy consumption, making the region extremely vulnerable to supply disruptions and price shocks. The Russia-Ukraine conflict demonstrated this vulnerability when natural gas prices spiked 340% in 6 months. The United States achieved effective energy independence through shale oil and gas production, substantially insulating the domestic economy from external energy price pressure. Japan imports 88% of energy needs, creating chronic vulnerability to global energy price fluctuations that directly impact inflation and trade balances. China produces 85% of energy domestically, but imports critical petroleum products for transportation and petrochemicals, generating mixed exposure patterns that vary by sector and region. These different energy profiles create fundamentally different inflation dynamics when global energy prices fluctuate. The same oil price shock that triggers inflation concerns in Europe and Japan might have minimal impact in the United States, while creating different pressures in China depending on the specific energy products affected. Demographics follow completely different trajectories that determine long-term economic growth potential and monetary policy requirements. Japan's population declined by 0.7% in 2024, accelerating a demographic trend towards structural deflation as fewer workers support more retirees and total consumption demand shrinks. Germany's working-age population peaked in 2020 and is declining at an accelerating rate, creating chronic labor shortages and wage pressures that require different monetary policy responses. The United States maintains modest population growth through immigration, supporting consumption demand, and providing demographic dividends that other developed economies cannot access. China's working-age population peaked in 2015, but total population growth continues slowly while the dependency ratio increases, creating deflationary pressures similar to Japan, but with different timing and intensity. Different demographic trends create different inflation pressures, different labor market conditions, different productivity growth patterns, and fundamentally different long-term growth potential that require completely different monetary policy approaches over time, horizons that extend beyond typical business cycle fluctuations. Government debt levels have reached dramatically different proportions across major economies, creating different constraints on monetary policy flexibility. Japanese government debt reached 254% of GDP in 2024, requiring continued ultra-low interest rates to maintain fiscal sustainability. Even modest rate increases would trigger debt service costs that could consume the entire government budget. United States federal debt reached 98% of GDP, approaching but not yet exceeding critical thresholds that would force fiscal consolidation. Current debt levels provide some constraint on monetary policy, but do not yet require emergency measures. German federal debt remained at 69% of GDP, well below levels that would constrain monetary policy and providing substantial flexibility for countercyclical fiscal and monetary policy. Chinese total debt reached 295% of GDP when including local government financing vehicles and state-owned enterprise obligations, indicating dangerous leverage levels that require deleveraging regardless of short-term growth impacts. These different debt levels create completely different monetary policy constraints. Countries with extreme debt burdens cannot tolerate significant interest rate increases without triggering fiscal crisis. Countries with moderate debt levels can adjust monetary policy more flexibly based on economic conditions rather than debt sustainability concerns.